Hi there, this is Karen with Coldwell Banker Distinctive Properties in Bozeman, and I'm here with Karen Goff of CMG Home Loans. And I thought we would just sit down and talk about home loans a little bit and kind of get through the basics of that. And I would also mention we both are horse people, so we had that in common. So we'll also talk a little bit about, what might be different about purchasing an agricultural property or vacant land for horses, properties with unusual buildings and that kind of thing. So I guess we'll just get started. So, hi Karen.
Hi.
So where are you located?
I'm in Cardwell, but I'm licensed throughout the state, and so a little bit different from a realtor. I can do an awful lot on Zoom and whatever, so it's pretty easy to be able to work with people from all around.
Okay, great. And do you work out of an office or your house, or?
I work out of my home office. CMG does have branch locations in Montana, but I'm fortunate enough to stay where my horses are.
And I guess since we're talking about that, I should mention we are in my tack room. So that's why you see saddles and saddle blankets and winter blankets and stuff behind us. So yeah, we're kind of sticking with the horse theme today. What do you think are the biggest misperceptions people have about getting mortgages, particularly today, these days?
I would say the biggest thing is thinking that they have to save up for a massive down payment, that there are an awful lot of programs that can get you in the door without that. And probably the biggest is this conception that rate is all being, that the lowest rate is always going to be the best deal. And there's so much that goes into it, and there's so much to actually understand that it's not about the rate. I mean, it is, but it's not. That's just one factor of everything that's going on.
So if you're shopping around and you're calling different mortgage brokers and banks, you don't just say, hey, what's your rate?
Exactly.
Thanks, bye.
Yeah. That's about the worst way to decide who you're going to end up working with.
How do you choose who to work with?
Well, from my perspective, I'm a little bit of a different animal. I got into the mortgage industry in 2019, and I was so frustrated because and then of course the refinance boom happened. And I thought, gosh, this is crazy. Like, as a loan officer, we see everything, it's a financial colonoscopy. We're looking at all of the assets and everything, but nobody talks about that. All anybody's talking about is eligibility. You're eligible for this loan. And I thought, gosh, I feel like there was a huge missed opportunity. So I was fortunate enough to find the National Institute of Financial Education, NIFE for short, which is much easier to say. And the beautiful thing about them is it's all about truly looking at mortgages and how they fit into our big financial picture.
Okay.
I mean, let's face it, when you own a home, it's, for an awful lot of people, your largest asset. It's also your largest liability for a while.
Right.
So it's really important to make sure that you're looking at that as you're looking at your entire financial future. So for me, that is, to me, the most important, which is very different. Most of the industry is looking at eligibility. What are you eligible for? I want to see what you're truly suitable for, and truly, like, I'm never going to just meet with my clients, get them in a loan, and then I'm done. I'm going to meet with them at least once a year, and I always ask for them to always reach out anytime there's any change in life. So figuring out, if you don't feel confident enough in yourself to really be able to make sure you're getting the best thing, it's really important to make sure you're working with somebody who truly can help you out with what's going to be this massive liability that you're about to take on.
So, and would you perhaps put a client with also a financial planner?
Yeah, very often.
Okay.
Yeah, so a lot of the time, that's a lot of what I work with. And if they have a financial planner, my first question is always, do they have one? Because if they do, I always want to pull them into the picture.
Okay. A question I get is, from my real estate clients, can you explain the difference between a mortgage broker, a mortgage lender, and a bank?
Sure. So I'm going to start not with the broker, but with a lender. A mortgage lender is somebody who's going to do mortgage loans. It's all we do. They vary in size, and depending on their size, it's going to depend on how much they have to offer. A bank is going to be what we're all used to, right? You walk in, you do all of your banking there, and they might or might not have a mortgage division. Depending on their size, they might have a very large one, or they might not have one at all. A broker, on the other hand, what they're doing is they're acting to run around and shop for mortgages for you.
Okay.
So they're like a middleman.
Okay.
And most of the time, they can have access to some of the big banks like Chase or whatever, or occasionally a credit union, and then their own lenders that they shop from. one thing to keep in mind, it doesn't really matter who you're going to there. For your standard mortgages, your Fannie, your Freddie, your USDA, your FHA, and your VA, all of those are going to have their own guidelines that are specific to them. And they're all different, and everybody kind of has their own nuances. On top of that, certain lenders or certain banks might add on their own criteria. So a bank might say, we aren't dealing with anybody under 640 credit. But that doesn't mean there isn't an agency that will. So it's important, if you get turned down, know why you get turned down, and then make sure you can go and talk to somebody else who might be able to help you out and explain more about what options you might still have.
Okay. As far as the credit rating, if somebody's struggling with that, if they're turned down because they have a low credit rating, and say they come to you and you still can't help them right now with a loan, do you advise them on how they can improve that credit rating, or can you put them with someone?
Yeah, for sure. And there are times, it depends. I always say, meet with a lender, come meet with me as soon as you possibly can, as soon as you're thinking about buying a home, because it can be so helpful in learning all those little things that won't trip you up in the end. In things like, okay, well, let's do this to help your credit. Or Homeward is a really great nonprofit based out of Missoula, but they'll work with anybody in the state, and they do such a great job of really helping people with those more challenging credit issues.
Okay, awesome. And since we're both horse people, and I work with a lot of horse people, is there anything different about getting a loan on a horse property?
Yes and no. So if it fits as when an appraiser comes in and says its highest and best use is residential, that means it doesn't matter what you're doing, whether you have a gym on there or a horse property or whatever. So I have personally 23 acres. It was hay and cattle when I bought it, and it's horses and hay now, but its highest and best use is a home. There's a house on there and it all works. So I have a Fannie Mae loan on it. Depending if it gets out of that, or if you want to use part of the income from the property that you're going to be using, now you're more into outside of the traditional mortgages. And that can be done. There's so many of them now. There's so many hobby farm properties and stuff like that. If you're getting into true ag, like it's really a massive horse property, then more of your ag loans is generally going to be.
And would someone go to you for that, or
they could? That's one of the places I can broker in a lot of ways. The other thing is you can always start with me, because I can help you look at those pictures, and then I have a lot of relationships with a bunch of the different ag lenders in the area, or some different specialty credit unions and stuff that can help out with those.
Okay, great. What do you think about the recent drop in rates?
That's a lot to unpack. First, you have to look at why rates went up to begin with. And so rates, and I guess you have to go back to why they were so artificially low. When everything happened with COVID, really how mortgage rates are determined is how mortgage-backed securities are trading on the open market. They are a bond that's getting bundled up together and sold. When mortgage-backed securities are trading really well, therefore people are dumping a lot of money in there, mortgage rates are very low. Now, what happened during COVID, the government wanted to stimulate the economy. How they usually do that is lower the interest rate, the Fed funds rate. They couldn't do that because it was already almost zero. So what they started doing was buying billions of dollars of mortgage-backed securities. So it artificially flooded the bond market, which made mortgage rates outrageously low. Well, with everything they did all around there, between that and then the stimulus and all of that kind of stuff, it was the catalyst that made inflation go crazy. The supply chain problems, all of that, all of a sudden was just building up a perfect storm of inflation. Bonds, any kind of bond, hate inflation, but especially long-term bonds. And mortgage-backed securities are generally a 30-term bond. That's a 30-year bond. That's a long term. So that made the mortgage industry very nervous, the mortgage buying industry very nervous. And so then top that off, the Fed funds started buying those billions of dollars a day, which made mortgage rates go higher. Inflation also went up. So as inflation kept going up and up and up, and it took the Fed a while to actually do something about it because they kept claiming it was transitory, when they realized it wasn't and start hiking rates, that doesn't, again, every time you actually saw a rate hike, we got a little bit of an improvement in mortgage rates because it made the bond market happy. Oh, yay, they're finally going to do something about inflation.
Okay.
But generally, it's still gone up.
Mm-hmm.
Now, really, why rates have come down recently is because the CPI report, the Consumer Price Index, which is the number one, everybody's favorite model of inflation, showed that inflation was finally slowing.
Mm-hmm.
So the bond industry got happy. People started buying more mortgage-backed securities. Mortgage rates came down.
Mm-hmm.
That same number is what made the Fed say, we can drop rates because inflation's looking better.
Right.
So then they dropped the Fed funds rate. Now, if you actually look at mortgage-backed securities, they actually went up the day that the Fed did that because they don't, again, now it's getting nervous. Was the Fed really going to keep a lid on inflation or not?
Mm-hmm.
So it's very different. And it's one thing to understand is that mortgage rates change hour to hour and day by day and month by month and everything else.
And company to company.
Yeah,
Somewhat.
that way too. And when you look at those rates that are posted, there's a lot that goes into that.
Mm-hmm.
It's not like there's a magic rate.
Yeah.
Add to that for every person, there's a whole bunch of different things.
Mm-hmm.
So it's very important, again, to talk to somebody and look at, and that goes back to the first question you asked me about one of the number one misconceptions.
Mm-hmm.
Rates, this all being thing that's going to determine everything.
Yeah.
It's just one part of the equation.
Right. When I bought my first house in 1988, I think it was, the rate was 11.75, and I know people at higher rates. So
yeah,
I think prices are as much of an issue or more than the rates right now.
Well, and
actually not bad rates.
Yeah, and an interesting thing then that happened, back then, house prices.
Mm-hmm.
My sister bought her first house in the 80s, and she paid it off in 15 years.
Mm-hmm.
But the reason was, back then, the median household price was 3.5 times the median income.
Mm-hmm.
Right now, the median household price is 6.5 times median income.
And I think that's the bigger problem.
Yes.
Yeah. It's very difficult for first-time home buyers.
Yeah.
Rebuyers, they
Yeah.
have some equity, so hopefully.
Yeah.
They bought, especially pre-2020, so. Can you explain the difference between FHA and conventional loans?
Sure. FHA is government-backed, so it's government-insured, and therefore there's a little bit of a generally more lax standards. It's going to allow for a lower credit score. It's going to allow for a higher back-end debt-to-income ratio, but not front-end. And just real quick, front-end, one of the things everybody's going to look at is your household debt, so that mortgage, everything that goes into the house, the mortgage payment, interest, taxes, insurance, and any HOA dues divided by your monthly income. That's your front-end ratio. Your back-end ratio is all of that plus all of your other debts divided by your monthly income.
Okay.
And so there's different, again, every single one is going to have different requirements. FHA is going to allow you to have a higher back-end ratio, so they're going to deal with more of your other debts.
Mm-hmm.
Conventional loans, now you're talking, well, two different ways you're going to talk about conventional. Conventional's the normal Fannie Freddie.
Mm-hmm.
And so that's a conforming mortgage. That's conventional conforming. They can be better if you need mortgage insurance. You can still get it. It's going to be private insurance, so they're going to want the higher credit rating and the better in order to get a reasonable pricing there.
Okay.
Again, depending on what you're doing, it's going to be very much dependent. A government loan is going to have a government appraisal, which is going to be more specific.
Mm-hmm.
So there's certain properties, especially if you're looking at more of a fixer-upper for yourself, that you aren't going to be able to go that route. You'd have to go more of a conventional loan.
Okay.
Within conventional, though, you also have to get into the non-conforming conventional. That would be the most popular, of course, jumbo.
Okay.
If you're over the lending limits, which just got, well,
Like
everybody's
800
spitballing are going to go up
something.
to 800. Yeah. That hasn't been released, but a bunch of lenders, including mine, are going, we'll just go ahead and lend at that rate. That is, anything over that is going to be a jumbo product.
Okay. So, as far as getting ready to purchase a house, let's say I know I want to purchase a house in the next 6 months. So I think we talked earlier about credit rating, like don't have late payments. As realtors, we always say, don't buy a car. Any other advice getting ready to purchase a house? Like, should you pay off car loans? Should you instead save that money towards a down payment, or you're probably going to say it depends, right?
Well, I would say that the number one thing is to talk with a lender. Reach out right away. As soon as you think you might be buying a house, I don't care if you think you're going to be buying a house in the next year and a half. Reach out, because let's start game planning that early.
So they'll look at your specific, or you'll look
Correct.
at specific situation and say, here's the best things to do to prepare.
And like what I would do with somebody is pull in what we call a soft pull credit report. So there's no ding on it, but it lets me see what I need to see. And then we can go ahead and discuss, okay, as I'm looking at this, you want to buy in this amount of time. Let's see what makes the most sense. Does it make more sense to pay down things, or does it make more sense to save the money?
Right.
And again, we're always looking at opportunity cost of what you can do with your money. Highest and best use of your cash and cash flow.
Yeah.
So what does that look like? How are we going to set you up to put you in the best position? A lot of what comes in there is things like people might think, oh, I'm changing jobs, which I'm always really careful about. I'm going to make more money, but how are you getting paid?
Right.
Because if how you're getting paid changes, you might now need a bunch of time in that new job before we can qualify you off of it. If you've never been commissioned and somehow this new great job has commission as a part of it,
right?
Well, now we need a 2-year history.
Yeah.
So, and the earlier you can talk to a lender in the process, and it's why people who I've ever done a loan for, because they might ever want to again, I always want them to talk to me about life changes.
Okay. Yeah, I know my husband and I are both self-employed with fluctuating income. And it can fluctuate greatly. So I assume that's a challenge. That could be a challenge.
It can. And thankfully, again, there's a whole world of what we call non-qualified mortgages, which sounds terrible, but it just means it doesn't fall into those neat little categories. And there's a ton of them. And for those, okay, you might not have 2-year history, but you're really ready to buy a house and you really are financially secure. Well, we might be able to have a bank statement loan that we can lok at, or a debt service ratio on an investment property or something like that. There are a bunch of other options out there, so don't get discouraged. At least a lender worth their salt's going to at least give you a plan.
That's good to know. Or do you deal with any special programs for first-time home buyers, or does that just kind of fall into the regular?
Yes, there are tons. One of the things that I made sure that CMG was signed up with Montana Board of Housing, and so we were able to take advantage of their programs, which if you fall into that category can be great, a great program. NeighborWorks, HRDC, all of those different ones might have different programs for lenders. Fannie Freddie, they both have for first-time buyers extra like cheaper mortgage insurance opportunities and better pricing and stuff. So yeah, for sure, there's lots of things out there.
Okay. And what's the percentage you need to put down to avoid mortgage insurance? Like it used to be 20%?
Yeah, to avoid mortgage insurance completely, that's still 20%. Yeah, and again, that's always a look of cash and cash flow, because there's been, somebody who could put in 20%, but they had to take it out of their IRA.
Yeah.
Well, what they're making there, your mortgage insurance, that payment is totally worth it, because it's going to drop off at a certain number of years anyway on a private mortgage insurance.
Okay. So I know lenders need to figure out a debt to income ratio, since we're talking about that. What ratios are currently allowed? Are they the same for all loan types? I'm sure the answer is no.
No, that's very different. So I'm trying to go off of memory here, but like the Fannie Freddie, they're usually going to let you go up to like 49 on the front end and 50 on the back end, which is about the highest you're going to get for the front end. FHA will let you go all the way up to 56 on the back end. Don't quote me on this, but I think they won't let you go any higher than 45 on the front end. USDA, they're 100% financing. So they're a little tougher because they're giving you all the money. And so they want a little bit, their 43 is about the max they're going to go to. Those specialty programs, again, Board of Housing is generally not going to let you get above 43%. With that being said, again, there might be different workarounds. There might be different things. Well, we can pay this off and do something else there. VAs are entirely different because they kind of have a working debt to income ratio, but really what comes down with a VA loan is that they have a residual income that as long as once all expenses paid, you have to meet at least a certain residual income and then you qualify.
Okay. And I think VA loans, that's something we could probably spend a whole episode talking about. So, yeah.
Yeah. Another thing that I think can be important about VA loans, particularly, we have the timing wise, one thing that can get tricky on those is the appraisal. It has to be done through VA system, and they have to give the appraiser 21 business days to turn it in. So if you have a 30-day buy sale, it's really important to get that appraisal ordered as soon as possible to make sure that there aren't any hiccups there.
Okay, good to know. What's the advantage of going with a local lender versus like these national lenders, online lenders?
Well, one, I would say and this
especially
sometimes
with horse properties.
Yeah. This can fall not just even with online, an awful lot of what you're doing is kind of more buying your mortgage as a commodity. The person on the other end is just going to look at eligibility. That does happen a lot of the time. If you walk into the bank or whatever, they're just thinking mortgages and that's all they're doing. One thing that you can really get tripped up on is things that they might not know about the area. So like Broadwater County requires a survey, a boundary survey, and it might already be on file, but if it's not, somebody better know to go do it. Government loans, if there's a well, they're going to require a well inspection. Well, what does it need to be tested for? Well, they might have to go research that, whereas somebody else who's familiar with it is going to know that. So those different things that can really hold up a loan, especially when you're coming down to the end and you don't find out until the last, the week before, can be problems that you can't get them done in time. So that can be a really big thing.
Okay. Do you think we'll ever see 3% rates again?
If the Fed loses their minds again and starts buying billions of dollars in mortgage-backed securities, but
right.
I mean, that was. I don't see the bond market ever actually naturally having that enough of that happening, but I can't, never say never because who knows? I don't think there was not a single solitary pundit in the world who was predicting that the Fed was going to do that. Everybody was very much taken aback when it happened, especially that it happened for so long.
And even looking back over this year, I think I saw a lot of predictions that didn't come true.
Correct.
What would happen even this year.
Yeah.
So. Yeah. What's the one piece of advice you'd offer a home buyer?
Understand your big picture. Understand your cash flows. We are not, it was really easy when rates were at 3% and all of a sudden somebody could get into a mortgage and buy a house for cheaper than they were paying in rent. That was pretty crazy. That made it easy to help them out into that position. Right now, we don't necessarily live there. And so, again, meet with it, get in touch with early, find out exactly what your payment's going to be, and then start making plans for that. So if you are if it is more expensive, start setting that difference aside every single month. Make sure you're comfortable with that. You're going to get two benefits of that. Do that for 6 months. Number one, now you're comfortable that you can make that bigger payment. Number two, you either have a bunch of debt paid off or you have extra money saved to go towards something.
Right. Okay.
And I will say, speaking of closing costs and stuff, or down payment, one of the things people always think, I want one of those free loans with no down payment. Well, there's still closing costs.
Yeah.
And you can get seller concessions to pay them, but it is something you have to factor into.
Sure. And the less down payment you have, the higher the mortgage too. So, so that's of course a factor.
Right.
Is there anything else I should have asked?
I don't think so. I think I would just encourage people very much that really, think of, we always talk about, again, a knife. It's the three-sided balance sheet. And when you have that house, you have assets. A typical balance sheet is assets and liabilities. Okay. But when you put that house in the mix, you kind of bring it together. And now, because it falls on both sides. And to really be sure that you look at how it all fits together. Because the things that seem to be standard, like a 15-year mortgage will save you more than a 30-year, or a large down payment will save you more than a small. All of those things are only true if mortgages lived in a vacuum.
Okay.
And they don't.
Right.
They live in the massive picture that is our personal financial economy.
Mm-hmm.
And so make sure you look at it that way and make sure you're setting yourself up for success.
I really like that approach because only last year we started talking with a financial planner and we realized we did a lot of dumb things like leaving money in a regular bank earning 0.25%,
right?
Or that kind of thing. So I think even if you're not the person to give this specific advice on all of that stuff,
right,
just to get the person thinking about that and realizing this is part of that big picture.
Yeah, and again, that's why a lot of the time I like to partner with financial planners, etc., so that I can, okay, look, you have a bunch of money sitting here, we should figure out something else to do. It's also a big part of the reason I'm at CMG, because we have a bunch of proprietary products that do really unique things that can really help somebody build wealth.
Nice.
Not just buy a house.
Yeah. Okay. Well, I really appreciate you meeting with me today and talking about all this, and maybe another time we can follow up on deeper dive into some of the specifics.
That'd be great. Thanks so much for having me.
All right, thanks.